Hey guys, Rob Wilson here from Instant Trading Results. We've got a pretty cool looking trade to show you here tonight, or today, whatever side of the world you're on. It's GS, has an IV ranking of 130.9, so not too bad, 130, nearly 131, good for a stock that has no earnings coming up. That's Goldman Sachs. Now, if we have a look at this, we can see the dotted line is my upper call strikes and the lower is my put strike, and I'll show you which ones in a moment. But if we have a look at this beautiful support level here. All right, down, up, down, broke support because of March. Right, now it's come back up again. Now that support level has become resistance, so it can't push up above that. So this is looking pretty nice. Let's zoom in. Okay, the point with an Iron Condor is we want to have our upper strikes at a price we don't think the stock's going to go to, and the lower strike is the strikes we don't think the stock's going to go down to. So that's what I'm looking at here with GS. So let's go and place the trade. Coming here, I'm going out to July 17. Okay, we're going to do an Iron Condor. And we're looking at the 195s, 200s. So we go... There's the 200, 195. So we're selling the 195s and then buying the 200s for our protection. On our puts, we're looking at the 145s and 150. Go down to 145, 150. So what we're doing in this case is that we're selling the 150s and then buying the 145s for protection in case it tanks. So our risk is going to be, we've got a $5 spread here and a $5 spread here. So your risk is the spread minus the premium that you can bring in. So let's bring over our trusty little sheet. So we can see here, we've got GS, we've got 195 200s, 145s, 150s. Our max profit is 185. So 1.85. And our risk, well, it's a $5 spread minus 185 a premium we bring in, which should be 315. So if we look down here, 315. It's now 317 because it's just changed from 185 to 183. So we're going to say 315. Let's bring our trusty calculator up. And we have, get this out of the way, we've got 185 divided by 315 equals a pretty cool 58% return. Okay, so as long as it stays in between those two bands, we're going to pick up a nice 58% return. 58. Now, of course, when we place this trade, when the trade gets filled, we place an order immediately to go and get out of the trade at 50% of our maximum profit. And we just keep regurgitating these trades, turning them over, turning them over, turning them over. Now, I've got something pretty exciting to show you here now. What if we made this a $10 spread? Okay, a lot of people say, well, if you don't think it's going to be below 150, why don't you go a $10 spread? So then you're going to lower your risk here on this, right? We've got a $10 spread. And here we go, a $10 spread on here. Okay, so we're actually going to increase the risk, of the whole trade because we've got a $10 spread. What I mean is that it's going to increase the premium. So premium increases, but so does the risk. So let's calculate this. Let's do a comparison. So we've got a $10 spread now instead of the $5 spread. So our maximum profit is $340. So now we've got a $10 spread, not a $5 spread. So our maximum risk is going to be the spread minus the income we bring in. So that's going to be 10 minus 340 is 660. 660. Bring up our calculator again. So we've got 58%. Let's have a look at this one now. We're going to go, what was our premium? 340 divided by 660. 51%. So what's actually happened is that by going the $10 spread instead of the $5 spread, yes, we've bought in more profit here, but our risk is greater. Right, we bought in $340 compared with $185, but our risk is $660. So our ROI has been reduced to only 51% instead of 58%. Okay, some people might say, okay, well, I'm all right with that. Right, I'm okay with this risk. Right, but for me, we've got to think that that amount of risk, so that $660 comes out of your account. So that's $660 that you can't be using on another trade. So for me personally, I would rather do 2 with the $5 strike, and that's up to $6.30 then. $630 would come out of the account, and I've got 2 orders on the same, 2 contracts. Hope that makes sense. All right, what I'm saying there is that, yes, you can make a greater return, but you need more money in your account to cover that margin. For me, I would rather double up on my contracts, right? And then so if I doubled up on my contracts, we've got 185 times 2 is going to be, what's that? 360, 370. So we're bringing in 370 instead of 340. Okay? Interesting, isn't it? That's the great thing about options, is that we have so many options. So in this case, doing 2 contracts on a $5 strike actually brings in more money than doing 1 contract on the $10 strike. Okay, hope that was insightful for you and you learnt a little bit out of that. As always, if you've got any questions, just drop them into the chat box in our Telegram group, and I'll see you in the next video.